summary of the most expensive book on Amazon.
All right, let's dive in. Today, we're going to crack open a piece of stock market history that's honestly way more relevant than you might think. We're heading back to the 1960s to check out a totally groundbreaking investment idea from a guy named George Levy, and we're going to figure out what it actually means for us today.
So this right here, this was the core idea in George Levy's 1968 book. And yeah, it might sound kind of simple to us now, but back then, this was a huge deal. See, pretty much everyone on Wall Street thought past performance had zero to do with future results. And Levy comes along and says, whoa, not so fast. The data says winners tend to keep on winning. He was basically laying the groundwork for what we now call momentum investing.
And that's the big question, isn't it? I mean, think about it. We're in a world of high-speed trading, AI, instant news. So can a system from way back then, when they were analyzing data by hand, can it really still be useful? Well, that's what we're here to find out. To really get this, you have to picture Wall Street in the 60s. It was a world that ran almost entirely on gut feelings, hot tips, that kind of thing. And then George Levy walks into this gut feeling party with a calculator and a system. He brought data to the party, and it was about to change the whole game.
And the key thing to get here is that this wasn't just a hunch for Levy. He built an actual system around it, something you could measure, something you could repeat week after week. Basically, he wanted to take all the guesswork out of finding the real market leaders.
So, how did he do it? You might be thinking it's some super complicated math-heavy formula, but it's not. It actually boils down to a really straightforward three-step system for finding and sticking with the top stocks. Let's get into it. Okay, so the beating heart of this whole thing is one single number. He called it relative strength, or RSL for short. And you gotta love the simplicity here. All you do is take the current stock price and divide it by its average price over the last 26 weeks. That's about 6 months. That's literally it. And that one little number, it gives you this incredibly powerful snapshot of a stock's momentum.
So what does that number even mean? It's super simple. If the number is above 1, it means the stock is trading higher than its 6-month average. Boom, it's a strong stock. And if it's below 1, well, it's trading lower than its average. It's a weak stock. The best way to think about it is like a report card for the stock, grading how it's doing right now compared to its own recent history.
So that one number is the engine for this really simple but powerful loop. Step 1, you calculate that RSL for a whole bunch of stocks. Step 2, you rank them all and pick the very best ones. And step 3, you review your portfolio regularly and you kick out anything that's lost its mojo. So when Levy was first testing this thing out, he used a list of 200 stocks from the New York Stock Exchange. And get this, he did this every single week, recalculating, re-ranking, just to get this constantly updated picture of who the true market leaders were. Okay, but here's where the real discipline comes in. The rule for buying was super strict. You didn't just go out and buy any stock with an RSL over 1. Nope. You only bought the absolute top dogs, the top 5%. For his list of 200 stocks, that meant he was only holding the top 10 at any one time. That's it.
And you can bet the sell rule was just as tough. If any stock you were holding started to lose steam and its rank dropped into the bottom 31% of that list, you sold it immediately. There's no emotion, no, oh, but maybe it'll bounce back. None of that. The system itself just forced you to cut the losers and ride the winners. Pure and simple.
All right, so that's the system he built back in the day. But like we asked in the beginning, what about now? And this is where the whole story gets really, really interesting. Because Levy's legacy is, well, it's super controversial. You've got people who think he's a genius, and then you've got others who basically dismiss his work. So on one side, you have his massive influence. His work is treated like a classic, right? A truly groundbreaking study that proved momentum was a real thing you could measure. But then, on the other side, you have the critics who say, look, the method itself is extremely outdated. They argue that with modern tech, with how fast the markets move now, his specific rules just don't really work anymore. And yet, here's the kicker. If you try to buy a copy of his original book today, you better be ready to open your wallet. A used copy can go from more than $1,600. That's insane. I mean, that price tag alone tells you something, right? Whether it's outdated or not, this book is seen as a piece of history, a real collector's item for sure. So, how do we make sense of that? How can something be both outdated and so influential at the same time? Well, I think the key is to separate the underlying principle from the specific prescription he wrote. At the end of the day, Levy's real legacy isn't the 26-week moving average. It's not the top 5% rule. It's the big, game-changing idea, which he backed up with data, by the way, that winners tend to keep winning. He was the one who really proved that momentum was a real, tangible force in the market, something you could actually measure and build a strategy around. And that idea, that's just as powerful today as it was back in 1968.
So, if this has got you curious and you want to dig a little deeper, there are a few great places to start. You could try to find his original 1967 paper in the Journal of Finance. It has a lot of the same stuff as that super expensive book. Or you could check out more modern authors, guys like Charles Kirkpatrick or Michael Carr. They've taken Levy's core ideas and really updated them for today's markets.
And all this leaves us with one last big question to chew on. We've seen how his exact formula might be a bit of a historical relic, right? But that core principle, that winners keep on winning, that seems to be timeless. So the real question for us today is this. Given everything we know now, what's the best way to measure and actually use that powerful idea of momentum in the markets we're trading in right now?